Here's something wild to sit with for a second.
100 years ago, if you wanted to buy a stock, you had to physically walk onto a trading floor and shout at another human being.
Today, you can move your life savings from your couch with your thumb. Railroads got replaced by artificial intelligence.
Entire industries that used to employ millions of people simply don't exist anymore, and new ones nobody could have predicted popped up in their place. And yet, underneath all of that chaos, there's a small set of investing rules that hasn't changed even slightly. Not since before the internet.
Not since before computers. Rules that worked when your grandparents were young, and rules that are still quietly deciding who gets rich and who gets wiped out today. So let's go through the 10 that matter most, because I promise you, at least one of these is going to rethink something you already own. Number 1, price matters more than you think. Here's a trap almost everyone falls into at some point, assuming that a great company automatically means a great investment. It doesn't. Picture a used car for sale. If it's reliable and priced fairly, that's a good deal. Now picture the exact same car, same mileage, same condition, but the seller wants triple what it's worth. Same car. Terrible deal. The car didn't change, the price did. Markets do this constantly, on a much bigger scale. When everyone's excited, people will pay almost anything, convinced the line only goes up. When everyone's panicking, they'll dump perfectly healthy assets for pennies out of pure fear, and the underlying business hasn't gotten any worse. The crowd's mood just changed. Finding something valuable is only half the job. Paying the right price for it is what actually makes you money, and skipping that second half is how otherwise smart people turn a great company into a terrible investment. Number 2, time is your biggest advantage, and almost nobody uses it correctly. The best investors on earth aren't the ones calling market tops and bottoms. They're the ones who simply let their money sit and compound for absurdly long periods. Here's the mechanic underneath that. Your money earns returns, and then those returns start earning their own returns on top. It snowballs, quietly, in the background, while you're doing anything else with your life, which is exactly why someone who starts investing small amounts in their 20s will almost always beat someone throwing huge amounts of money in during their 40s, purely because of how many extra years that snowball got to roll. It's not about how much you start with, it's about how long you leave it alone. Zoom into the market over 3 months, and it looks like a terrifying roller coaster, full of drops that make the evening news. Zoom out to 30 years, and those exact same terrifying drops shrink down into tiny speed bumps you can barely even see on the chart. The single biggest mistake people make is jumping from one hot trend to the next, chasing whatever's working right now, which resets that compounding clock every single time they do it. You can't control what the market does next Tuesday. You can absolutely control how long you leave your money alone, and that's the lever that actually matters. Number 3, keep your money safe before you even think about profit. Here's math that a lot of people skip over, and it's brutal once you run the numbers. If a bad investment wipes out 50% of your account, you don't need a 50% gain to get back to even. You need a 100% gain on what's left just to break even. That can take years, sometimes an entire decade to claw back. So instead of asking, how much could I make here? Experienced investors ask a completely different set of questions first. Could this business survive a real recession? Are they buried in debt they can't easily service? What happens if this goes wrong in the worst realistic way? And here's the part people underestimate. Holding cash isn't wasted money sitting on the sidelines doing nothing. It's ammunition. When the market eventually crashes, and it always eventually crashes, the investors sitting on cash get to buy incredible assets at a steep discount, while everyone who went all in with no cushion has already been wiped out and can't participate in the recovery at all. Number 4, only buy what you actually understand. Nobody hands out bonus points for owning the most complicated, most exotic product in your portfolio. Before you put money into anything, you should be able to explain, in plain language a 12-year-old could follow, 4 things: how it makes money, why customers pick it over the competition down the street, what could realistically hurt it in the next few years, and why it'll probably still matter in 10 or 20 years. You don't need an engineering degree to invest in a tech company, and you don't need a medical degree to invest in a healthcare company. You just need a clear picture of how the business actually works and makes its money. And honestly, saying "I don't understand this one" out loud might be the single most powerful sentence in investing.
It's the sentence that keeps you out of hype cycles other people are about to regret chasing, usually right before those same people learn this lesson the expensive way.
Number 5. Your emotions are the enemy, and they're sneakier than you think. Everyone believes they're logical and level-headed, right up until the market starts moving hard in one direction.
When a stock is rocketing upward, buying feels safe because everyone around you is getting rich and the fear of missing out kicks in hard, overriding whatever careful plan you had. When the market crashes, selling suddenly feels like the smart, responsible move because everyone else is running for the exits too, and staying put feels reckless. Here's the uncomfortable truth underneath both of those feelings. The technology changes every decade, the headlines change every single week, but human psychology hasn't budged in centuries. Excitement always curdles into overconfidence.
Fear always curdles into panic. You could have the mathematically perfect financial plan sitting on paper in front of you, and it means absolutely nothing if you don't have the discipline to actually stick with it while your account is bleeding red and every instinct is screaming at you to do something.
Number 6. Never bet everything on one outcome. Every single decade produces some massive event almost nobody saw coming. A pandemic that shuts down the world, a banking system freezing overnight, inflation spiraling out of control while everyone's savings quietly lose value. Diversification isn't a buzzword you hear from a financial advisor trying to sound smart on a brochure. It's a straight-up acceptance that the future is unpredictable. Full stop. Farmers plant more than one type of crop because the weather is unpredictable and one bad season shouldn't wipe out the whole farm. Airlines run large fleets instead of a single plane because individual planes break down. Manufacturers use multiple suppliers because supply chains snap without warning, sometimes on the other side of the planet. Every single investment you make is really just a bet on how the future unfolds, and rising interest rates might crush one industry while quietly benefiting a completely different one at the same time. You're never going to eliminate uncertainty. Nobody can, no matter how smart they are. But you can build something that survives no matter which version of the future actually shows up on your doorstep. Number 7. You're buying cash flow, not a number flashing on a screen. A stock isn't just a flickering green ticker or a line on a chart. It's a legal, fractional slice of ownership in a real business, with real employees, real customers, and real bills to pay every month. A rising share price feels exciting, sure, but excitement doesn't pay salaries, and it definitely doesn't fund research and development for whatever comes next.
Eventually, every single company has to turn its sales into actual hard profit. There's no way around that forever. Cash flow is what's left over after the business pays everything it owes, and that leftover cash is exactly what funds dividends, stock buybacks, and real expansion into new markets.
If a business consistently can't generate real cash, no matter how good its story sounds, its stock price will eventually catch up to that reality, no matter how popular the company is on social media right now. Number 8. Ignore what's popular. The market has an ugly habit of making popular ideas dangerously expensive, almost every single time. Here's how the cycle runs. A company gets popular, demand pushes the price up, rising prices attract media attention. That media attention attracts even more buyers, and suddenly the price has climbed to a level the company can never realistically live up to, no matter how well it performs. Then confidence cracks, usually all at once, and the exact same cycle runs in reverse. Selling triggers fear. Fear triggers even more selling, and the price falls faster than it ever climbed. Meanwhile, the actual underlying value of the business barely moved the entire time. It takes years for real business fundamentals to genuinely double. It can take mere months for public hype alone to double a stock price with nothing real behind it. Long-term wealth gets built by tuning out the mood swings of the crowd, not by chasing them one trend at a time. Number 9. Volatility and risk are not the same thing, and mixing them up costs people entire fortunes. Volatility is simply how much a price bounces around from day to day. Say a local grocery chain stock drops 5% because of some scary headline on the evening news about the economy. The stores are still packed with customers. People are still buying groceries every day. The business itself is completely fine. The price just wobbled because of noise. That's volatility without any real risk attached to it. Risk is something else entirely, the real possibility of permanently losing your capital and never getting it back. A company's stock price could stay perfectly calm and stable for an entire year, while behind the scenes, customers are quietly leaving for a competitor, debt is silently piling up, and rivals are eating its market share alive one quarter at a time. The price looks stable and boring. The danger is building the whole time, invisible until it isn't. Learn to tell those two apart, because one of them is background noise, and the other one can actually ruin you financially for years. Number 10, think like a probabilist, not a fortune teller. There has never been such a thing as certainty in investing, and there never will be, no matter how confident any expert sounds on television. Markets don't hand out guarantees, they hand out probabilities that update constantly, second by second. If a meteorologist says there's an 80% chance of rain tomorrow and it turns out sunny, the forecast wasn't wrong. Sunny was just the 20% outcome that happened to show up that particular day. Every single trading day, markets absorb millions of new data points. Interest rate moves, shifts in consumer behavior, fresh earnings reports landing overnight, and prices adjust in real time to reflect that new reality. Successful investors accept, fully and permanently, that they're weighing possible futures, not predicting one guaranteed outcome, and that genuine surprises aren't just possible, they're guaranteed to happen eventually, probably sooner than anyone expects. So here's the real takeaway from all 10 of these.
The tools have changed completely. The apps, the algorithms, the sheer speed of information. None of that existed 100 years ago, and a lot of it didn't exist 20 years ago either. But the actual rules underneath all of it, price discipline, patience, protecting your downside before chasing upside, understanding what you actually own, managing your own emotions when it counts most, spreading your bets instead of betting it all on one outcome, following real cash flow instead of a flickering number, ignoring the herd when it gets loud, knowing the difference between a wobble and a real threat, and thinking in probabilities instead of false certainties. Those have been quietly true the entire time, through every crash and every boom, and they'll still be true 100 years from now, long after whatever's trending today is completely forgotten.
If even one of these hit differently for you while you were watching, that's a sign worth paying attention to. Subscribe so you don't miss what's coming next. Drop a like if this changed how you're thinking about your own money. And tell me in the comments, which one of these 10 are you the most guilty of ignoring?